Have you been struggling to find good trade ideas related to AI? Have you lost money trying to chase NVIDIA shares again? Watch this video till the end. We comprehensively present a high conviction trade idea that we believe will benefit from the age of AI. At the Financial Traders Hub, we consistently find spectacular trade ideas that generate high returns. Make sure you're subscribed so you can learn how you can generate your own endless pool of opportunities from the stock market. We've decided to buy Lumentum Holdings. In this video, we'll share why we believe this might be a really good trade idea. We'll look at the company and what's changing within the business. Most importantly, we'll look at the factors that are driving the share price and uncover some areas of opportunity for the share price. But before that, your favorite slide. Guys, this is not financial advice. Everything that we discuss here is purely for educational basis. So, Lumentum Holdings, what does the company do? It manufactures and sells optical and photonic products for optical communications and commercial lasers. It's currently trading at $59.24 with a market cap of $4 billion. It has a forward price earnings ratio of 61.8 times, so we'll need to understand why the forward PE is so high. Also, it has a short interest currently standing at 15%. This is equivalent to 9 days to cover. So for those who don't really understand what this means, it means that everyone who's short this stock, for them to cover, as in buy back their short position, it will take them 9 days to be able to close all their positions. In terms of analyst expectations, we can see that they are expecting significant revenue growth for financial year 2025 and 2026. So we'll need to dig a little bit deeper into that to understand how realistic these numbers might be. Side by side, because revenue is increasing so much, they're also expecting EPS, as in earnings per share, to increase quite significantly. As an example, for financial year 2025, they expect 69.5% growth in the EPS, and for the following year, 120.9%. Now, we also have to look at these numbers in perspective. If we look at financial year 2023 and 2024, the revenue growth numbers haven't been that great. So particularly in financial year 2024, the company has seen a pretty significant drop in revenue. And with that, the EPS has been drastically declining. So when we look back at the share price, we can understand why the share price has dropped so much in the last 12 months. So digging deeper in terms of what the company does, we can split it in two business segments. The cloud and networking components consist of optical and photonic components, which are eventually sold to telecommunication providers and data centers. Then they have a smaller segment, which is industrial tech, which consists of commercial lasers that have a wide range of applications. So if we look at the financials of last quarter, we can see that the revenue has dropped year on year, and management has highlighted that this is due to high inventory that had accumulated in COVID times. Also, they've highlighted that the telcos have been reducing capital expenditure, so that directly impacts the new orders that Lumentum Holdings would get. In the industrial segment, management has indicated that it's still struggling, but as we can see, it's only a small portion of the total revenue mix. Management also indicated that they had lost a major client following one of their acquisitions, which is called LITE. So all of these factors have led to a revenue drop. At the same time, we know that with reduced revenue, that leads to lower fixed cost absorption, which eventually leads to lower margins for the company. And finally, this leads to reduced EPS. We've also had ongoing merger-related costs that had impacted the margin. However, revenue has been stabilizing sequentially, led by the cloud and networking segment, which on its own grew 9.4% quarter on quarter. Margin has also improved, but the industrial segment is still struggling. For a company like Lumentum Holdings, it's critical for us to understand what's driving its industry. More particularly in the cloud and networking segment, where we've seen a significant rise in revenue quarter on quarter, what we've seen is that the prominence of artificial intelligence or machine learning has been leading to a fresh wave of technological upgrades within the data centers. So while the telcos have reduced their spending, the data centers have more than offset for the reduction in expenditure by the telcos. And that's predominantly because the data centers are under pressure to upgrade their technologies in light of all the demands that AI will place on them. In Q2 2024, Lumentum Holdings reported that 800G devices were now accounting for 75% of the cloud transceiver revenue. That's drastic because only 12 months ago, 800G devices were accounting for only 37%. So we can see that there has been a rapid adoption of 800G devices across the industry. And that's, as I've said before, mainly being led by data centers. Moving on to its competitors, let's look at a company called Coherent. Coherent is much more diversified and also much larger than Lumentum Holdings. What are they saying about the industry trends? They're confirming what Lumentum Holdings has been saying. They're also saying that the data communications market is inflecting, and all of that is being led by AI. As we can see in the graph, they also expect rapid adoption of the 800G devices and later on the 1.6T devices. I'm not going to go too much into details, but essentially what's happening is that the data centers are adopting devices that have much higher transmission speeds. And all this demand is being caused by the prominence of artificial intelligence. So, if we look at what Coherent was saying last quarter, they said that they enjoyed a fourth straight quarter of strong demand for AI, machine learning related data communications transceivers. So exactly the same product line that Lumentum Holdings is selling. So all of this information is definitely confirming what we're seeing from Lumentum Holdings, but more importantly, it's also confirming that this trend is still early. There's a lot more to play, and as we go along, especially in 2025, we'll start seeing the adoption of 1.6T devices. So this creates a great opportunity for companies like Lumentum Holdings, which tend to be very exposed to this type of product line. Moving on to another company called Celestica with ticker name CLS, they are also guiding for strong revenue growth in the mid-40s for next quarter in their communications segment. This definitely confirms what we are saying, that the space is seeing rapid investment in technological upgrades. They mentioned that data center revenues have been achieving a record quarter. They also give some light on the telco industry, where there has been challenges with high inventory levels. However, they mentioned that they are a bit more confident now that the telcos have been drawing down inventory to a level where they believe that they'll start to see new orders. They haven't really given us an indication as to whether that's going to happen next quarter or maybe later, but they are painting a picture where they see that the telcos will now start ordering a bit more. I personally think that it might not be in the next quarter. It might take 1 or 2 more quarters, but you never know. That's always a good upside surprise to have for the stock. Management also spoke about multiple cloud customer engagements where they've been doing testing, pilots, and also been getting a lot of good feedback for their customers. This, I think, paves the way for future revenue growth. And I think we can now start seeing why the analysts have such high revenue growth for the company. I think this bodes well for the company. And as we dig deeper into the thesis, we need to understand whether analyst expectations are realistic. Because if we're going to be buying this company at a 61.8 times forward PE, we really need to make sure that these numbers are achievable. Moreover, management also indicated that all this explosive growth in data center is coming from AI-driven demand. They also mentioned that they are seeing strong early demand for their telecom products. Again, that's them telegraphing that the pain in the telco sector is probably reducing and maybe we are at an inflection point, but I'm not going to bet that this happens in this particular quarter. It definitely bodes well for future revenue growth, but maybe we need to be realistic here. It might take a quarter or two or even longer. So according to management, they think that the inventory correction is probably abating, and that makes them a little bit more positive in terms of their outlook for future revenue growth, especially from the telco sector. They also gave some commentary around the operating margin that saw a slight improvement due to them lowering operating expenses. This is part of a cost-cutting plan that they've been implementing for many quarters, and I'm quite happy to see that working. So whenever we talk about revenue growth, we also want to understand how that extra revenue trickles down into the EPS. This is something that we call operational leverage. So basically, if you think about a business, it's only three numbers. Revenue minus costs equals earnings. So we need to understand what is the relationship between revenue, cost, and earnings. Essentially, what we're talking about is what is the level of fixed cost at which, when that's fully absorbed, the extra revenue basically just trickles down to EPS. This is what we call operational leverage. We really want to see how the extra revenue will trickle down to earnings. So management has provided some color in terms of how operating margin will increase as revenue increases. At the moment, the operating margin is around 3%. However, if the company were to increase its revenue to $425 million, that operating margin would be in the range of 9 to 12%. So very significant jump from 3% to 9 to 12. Now, if the company were to achieve a quarterly revenue of $500 million, the operating margin would be in the range of 17 to 20%. So that's a very significant jump from where we're currently sitting, which is 3%. So again, all we're trying to do here is to understand if the analysts' expectations are realistic and to kind of map out a path for us to get there from where we're currently sitting. And management has provided a target financial model, which you can look at in more details to understand how they get an increase in the operating margin. One of the things that I mentioned in my earlier video where we did an initial analysis of Lumentum Holdings was the convertible notes on the balance sheet. So that's always something that worries me a little bit because convertible notes tend to be very dilutive to the equity and therefore is always an overhang for the equity or for the share price. However, in financial markets, we don't look at things in absolute terms. There are principles that you need to understand, but then you have to take everything and interpret it in the right context. However, what we realized is that last quarter, management had bought back all the 2024 convertible notes for $323 million. This was an overhang on the share price, and we can see that the share price has recovered slightly after that announcement. Now we need to look at the balance sheet again to understand what are the other outstanding convertible notes, and more specifically, the terms of these convertible notes. As you can see, the next maturity is now in 2026, and then we've got two other maturities in 2028 and 2029. Most importantly, what we can see for these three different convertible notes is that the conversion price is much higher than where the current share price is trading. This bodes well for us because it means that over our trade horizon, the convertible notes will not necessarily be a cap to the share price. This is something that I was initially quite worried about, but after doing some more in-depth analysis, I realized that over the trade horizon that we've got, it's not going to be an issue. So you might be asking, why did you choose Lumentum Holdings? Well, we've already established that there is a strong industry tailwind being led by artificial intelligence. We believe that Lumentum Holdings has the right product suite to be able to ride these industry tailwinds. More specifically, Lumentum Holdings is positioned perfectly for intra-data center upgrades and inter-data center upgrades. I'm not going to go too much into details on the products that they've got. Lumentum Holdings is also paving the way to future revenue growth. They're currently testing next generation products with existing clients, getting good feedback, and management has already indicated that they're expecting new shipments to come out of this exercise. Most importantly, Lumentum Holdings has a high revenue exposure to data centers and telcos, which are leading increased investments in technological upgrades in networking solutions due to artificial intelligence. There are also a couple of other operational factors to take into consideration that play in Lumentum Holdings' favor. They are expected to add new capacity with a manufacturing facility in Thailand. This will allow them to diversify away from manufacturing in China. As management has indicated, this is a requirement for many of their US clients. They also believe that the Thailand factory will start producing samples for testing and qualification soon. They believe that they will be able to ramp up production in December. So we have a situation with strong industry tailwinds for multiple years, and we have a company that's currently adding manufacturing facility to be able to fulfill all that demand. I think that's quite positive. It's also important to realize that Lumentum Holdings is vertically integrated and has a global manufacturing footprint. If you remember correctly, vertical integration helps the company to manage cost and therefore increase margins as revenue ramps up. So what about the catalysts for this trade? We believe that there is a possibility that management will come out with bullish guidance for financial year 2025 in light of the industry tailwinds. This could cause analysts to further upgrade the stock. We also believe that there is a potential for quicker recovery for telco spending due to the normalized inventory levels that management has been highlighting. However, we do realize that the thesis is not centered on telco spending recovering in the next quarter. This is just a potential upside surprise that we might have in next quarter's earnings. We also believe there is a potential for share buyback. Management can buy up to $1.2 billion until May 2025. They've already utilized $630 million. However, in the last 9 months, they have not bought back any shares. And we suspect that this could be because they needed cash to repay the 2024 convertible notes. Now that that's gone and the next maturity is only in 2026, we believe that management could reinstate its buyback plan. This will definitely be a positive for the share price. We also believe that there is a potential for positive earnings from Lumentum Holdings competitors, which will further confirm the growth potential across the industry. This will definitely give a boost to the sector and to Lumentum Holdings share price as well. We can also see some macro tailwinds here from interest rate cuts as inflation seems to be under control now. Another factor that we alluded to at the beginning of the video is the high short interest. There is a possibility that shorts get squeezed, especially if we have a very strong earnings quarter. And as we've seen, it will take around 9 days for all the shorts to cover. So as the shorts buy back their positions, this will give a further boost to the share price. So how are we playing this? Well, we've already put the position last week when it was trading around $56, Now it's trading at $59.24. We have a target share price of $70 and our trade horizon ends on the 20th September 2024. So there is enough time between now and then for the share price to move, and it could even move beyond 70 if what we are seeing within the company actually plays out. So at the moment we've got what we call a bull-call spread. We've bought calls with strike 62.5 with expiry on 20 September 2024, and that cost us $2.75 per contract. We've then sold calls with strike 70 with expiry on the 20th September 2024 for $1.72. That gives us a net cost for the bull call spread structure of $1.03. For us to achieve a minimum 300% return on investment, we need the share price to go to around $66.6. That's not very far from the current share price, and it doesn't look unrealistic based on all the industry tailwinds that we've seen. And if the share price goes to 70, our return on investment would be around 628%. Not bad, hey? As always, when we look at these trades, we also need to understand what are the risks to the thesis. In this case, one of the risks is deferral of orders by clients. We might run the risk that the telco sector takes much longer to draw down their inventory levels and therefore defer new orders. We also have the risk that the Thailand factory takes longer to start production. Delays from the qualification process could cast serious doubts as to the future revenue and EPS growth potential of the company. There's also the possibility of industrial tech losses continuing, and that the ongoing merger restructuring costs keep impacting EPS. Well, we know that management has been right-sizing the business and are on track to achieve their cost-cutting plans. However, this is still a risk that we cannot ignore. Another risk is that the stock has already rallied a lot since the lows. It's not unlikely that the stock could take a breather and trade sideways from here, or even sell off significantly post-earnings. Not because the company is not doing well, but just because everyone has been long the company and are now taking profits at the same time. So we need to factor this in the way we structure the trade. There have been fears that GDP growth has been stalling, and with that, risk assets could sell off quite sharply. However, we believe that this is unlikely to impact investment in the industry, but we have to be cognizant of this. There's a lot of times when stocks do not necessarily trade purely on fundamentals, but there's a lot of times when the stock does not only trade on fundamentals. Macro environment is also very important to determine the path of the share price. So we need to be aware of this so we can find another idea to diversify away this risk in the portfolio. Another likely scenario is that we get a broad sell-off in the mid-cap space, and this will probably impact LITE as well. Let me know in the comment section below how you find the video, if you have any questions, and also if I might have missed anything in the video. Make sure you're subscribed so you can benefit from all the videos that we've got lined up for you in the future. Our goal is to help you learn how to navigate financial markets profitably. I'm excited to also let you know that the Financial Traders Hub community is now growing. We now have a Discord server where we're discussing trade ideas in real time, discussing our industry and macro outlooks, and also covering quarterly earnings. Click the link in the description below so you can join our community while it's still free. Everything goes behind a paywall very soon. Happy trading everyone. Good luck out there.